Okay, let's unpack this. When most people think about, the really big power players in North American healthcare, you probably think pharma companies, right? Or maybe the giant insurance firms.
Yeah, the manufacturers, the payers, they get the headlines.
But there's this massive system underneath it all, kind of like the circulatory system for the whole industry.
That's a great way to put it.
And today, we're doing a deep dive into a key part of that system, McKesson Corporation, ticker MCK.
McKesson is, well, it's truly foundational. You could call it the indispensable linchpin. Its scale is just staggering. Hard to really wrap your head around sometimes.
And the story here is fascinating because of this central paradox, isn't it?
Exactly. You've got the largest pharmaceutical distributor. Globally, they're projecting, what, $359.1 billion in revenue for fiscal 25? Massive. And they operate in this really stable market in oligopoly.
Right. Very few players.
But here's the twist. Moving all that product. It's a razor-thin margin business, super high volume, but the core operating margins are typically, maybe 1%, sometimes 2%.
Wow. Moving almost $360 billion worth of stuff just to squeeze out a few billion in operating profit. I mean, they must run on pure operational perfection.
They absolutely have to. Efficiency is everything.
So our mission today isn't just to look at McKesson as like another stock. It's really to understand this huge strategic shift they're making.
It's a major revolution.
We're looking at how they're taking that incredible scale, that rock-solid cash flow, what was it, $5.2 billion in free cash flow last fiscal year?
That's the number for FY25, yes. Predictable cash generation.
And using it to pivot.
Yeah.
Really decisively pivoting away from just being this logistics machine and moving into higher growth and, crucially, higher margin areas. Healthcare services.
Specifically, the big focus is oncology and biopharma technology. That's where they see the future value.
So it's a story of like strategic repositioning, almost like organizational surgery.
I think that's fair. They know their identity as this huge low-margin distributor is kind of overshadowing, maybe even suppressing, the value of their faster-growing parts.
The oncology services, the tech platforms.
Yeah, exactly. Those assets get lost in the sheer size of the distribution business on the consolidated financials.
Okay. So the goal for you listening in is to see how this big internal change, this restructuring, is really designed to redefine McKesson, to unlock shareholder value that's kind of hidden right now.
Hidden behind that massive, consolidated, low-margin identity. That's the core idea.
All right, let's start with that role. You called them indispensable. Let's define that. What exactly is McKesson's job day-to-day in this healthcare chain?
Well, conceptually, it's simple, but the execution is incredibly complex. They're the middleman, the main traffic controller, if you like.
Okay.
McKesson buys pharmaceuticals, medical supplies, complex biologics, everything from hundreds of manufacturers, some domestic, some international.
And then gets them too?
To their customers. A huge network, over 285,000 of them. Think major hospital systems, big retail pharmacy chains, independent pharmacies, doctors' offices, clinics. The whole spectrum.
The sheer numbers involved must be mind-boggling. You mentioned the revenue, but what about volume?
The volume is immense. They deliver over 40 million products every year. 40 million.
Wow.
And that means coordinating logistics for literally millions of different SKUs.
Right.
Stock keeping units. Across a network that has to operate flawlessly. 247.
The operational pressure must be relentless.
It is. They're managing incredibly complex inventory. It's not just about keeping shelves stocked. Think about temperature-sensitive drugs, biologics. They need strict cold chain infrastructure.
Which must cost a fortune to build and maintain.
Hugely capital intensive. And then there's managing shelf life, expiration dates, handling controlled substances under tight regulations. It's layers upon layers of complexity.
And their performance on this is basically their defense.
Absolutely. The source material we looked at highlights a 99% pharmaceutical order accuracy rate in North America. That's stunning.
99%.
You just can't run a modern hospital or a busy pharmacy without that kind of reliability. It's table stakes, but achieving it at their scale is the moat.
Okay. That reliability, plus the huge cost you mentioned, that leads us straight to the market structure. This isn't exactly a wide-open competitive market, is it?
No, not at all. It's a classic oligopoly, highly concentrated, mature market.
You basically have the big three.
That's right. McKesson, Cencora, which, people might remember as AmerisourceBergen and Cardinal Health.
And together they control almost everything.
Estimates put their combined share of the U.S. wholesale drug market somewhere between 95% and 98%. It's incredibly consolidated.
And McKesson's the biggest of the three.
Yes, McKesson is the market leader. roughly a 37% share, give or take.
Okay, wait a second. If they're moving that much volume, billions and billions, but the margins are so thin, why hasn't someone like Amazon with all their logistics power just come in and disrupted this? Why is this oligopoly so stable?
That's the key question, isn't it? The barriers to entry are just incredibly high, deeply entrenched.
Okay, like what?
Well, first, just the sheer capital needed for nationwide scale. It's staggering. You need this huge network of massive automated distribution centers, all strategically placed.
Millions, maybe billions in real estate and equipment.
Billions, easily.
Yeah.
Second, think about inventory financing. These distributors are essentially fronting the cost for billions of dollars worth of inventory. Plus, managing the accounts receivable. The working capital requirements are enormous.
Okay, capital, working capital. What else?
Third, the regulatory maze is just intense, especially dealing with the DEA, the Drug Enforcement Administration, setting up the systems, the security, the tracking for controlled substances to meet their requirements. That's a multi-year, multi-billion-dollar challenge for any potential new entrant. It's daunting.
So physical scale, capital, regulations, those are huge hurdles.
They are, but honestly, that's only half the story. Where it gets really interesting, as you said, is the customer side. The competitive moat, the real stickiness comes down to switching costs.
Meaning it's really hard for their customers, hospitals, pharmacies to leave them.
Almost impossible, or at least prohibitively difficult and risky. That's the core of their staying power.
How so?
Well, think about a big hospital system or a pharmacy chain. They are deeply integrated into McKesson's own software systems. Things like McKesson Connect. It handles everything: ordering, inventory forecasting, delivery scheduling, payment.
It runs their pharmacy operations, basically.
Pretty much.
Yeah.
Now imagine trying to rip that out. Unwind all that customized IT integration, migrate years of data, retrain thousands of staff on a new system. The operational risk is immense.
You could have chaos, drug shortages during the switchover.
Exactly. The risk of just operational failure screwing up patient care is often just too high for a hospital or pharmacy to even consider switching, even if another distributor offered slightly better prices.
The risk outweighs the potential savings.
Precisely. And there's more. Customers also get locked in through things like purchasing alliances. McKesson has its Clarisone venture, for example, specifically for sourcing generic drugs.
So they use McKesson scale to get better prices on generics.
Exactly. It allows pharmacies, especially smaller ones, to pool their purchasing power and get access to the lowest possible generic prices. If you leave McKesson, you might lose access to that buying power.
And generic margins are already thin, so that could be fatal for a pharmacy.
It could be. It creates this powerful network effect, you see. The bigger the distributor, the better the pricing deals they can negotiate, which makes more customers want to join them, which makes them bigger still. It reinforces the dominance of the big three.
So the competition between McKesson, Cencora, and Cardinal is this hyper-efficient race on logistics costs, squeezing out basis points.
Right. Tiny improvements in efficiency matter hugely.
But the protection against new players coming in is almost like a fortress wall.
Extremely strong barriers, almost insurmountable, arguably.
Okay, let's just summarize the core economics here before we move on. Massive revenue, $359 billion projected, but it structurally delivers low profit margins.
That's the fundamental reality. You look at their biggest segment, U.S. pharmaceutical distribution, $327.7 billion in FY25 revenue. Incredible top-line growth.
Yeah.
But the industry is just designed for low operating margins, that 1% to 2% range. Success isn't about charging more. It's about being relentlessly efficient.
The difference between profit and loss is measured in tiny fractions of a percent.
Basis points, exactly. Logistical excellence, cost control, those are the only real profit drivers. Price differentiation. Largely irrelevant in the core distribution business. It's the sheer volume they push through that generates that huge, stable cash flow we talked about.
Okay, so that brings us back to the paradox. If the core business is so stable, so essential, generates so much cash, why has McKesson's overall valuation historically been kind of low compared to other healthcare giants?
Right, it seems counterintuitive. It's because the market tends to value growth potential more than just stability. And historically, the market has looked at McKesson's core distribution business and basically said, okay, that's a utility.
Like a water company or an electric grid. Essential, stable, but slow growing.
Exactly. And utilities get valued at pretty low multiples. We're talking price to sales ratio sometimes down around 0.2x, just very low.
So that massive low margin business acts like an anchor on the overall company valuation.
It does. It effectively suppresses the perceived value of their other faster-growing, higher-margin businesses. It's like McKesson is this giant, reliable utility truck that happens to have a Ferrari engine bolted inside.
Huh. Okay.
And the market mostly just sees the truck. It doesn't fully recognize or value the Ferrari engine separately.
Okay, that makes sense. And that explains why they're doing this big strategic restructuring they announced in September 2025, effective Q2 fiscal 26. This isn't just moving boxes around on an org chart, is it?
No, absolutely not. It's a very deliberate strategic move designed to force investors to see the different parts more clearly, to facilitate what's called a sum of the parts valuation.
Meaning value each piece on its own merits.
Precisely. They want their financial reporting to mirror their strategic priorities. So they're breaking it down into three main operating segments.
Okay, what are they?
First, North American Pharmaceutical. That's the core, stable, lower-growth distribution business, the foundation.
Got it.
Second, Prescription Technology Solutions, or RxTS. We'll get into that.
Okay, tech solutions.
And third, and this is really the key focus for growth, the Oncology and Multi-Specialty segment.
Oncology and multi-specialty. That's the Ferrari engine.
That's arguably where the highest hopes for future growth and margin expansion lie. Yes.
Yeah.
This new structure makes it much clearer for investors to see the distinct economics and growth profiles of each part, and hopefully assign different, higher valuation multiples to the non-distribution pieces.
And part of this is also about getting rid of slower stuff, right? They're planning to separate the medical surgical solutions segment.
Yes, that's a huge part of this purification strategy, as they call it. They intend to spin off the medical surgical segment into its own separate, publicly traded company.
Why do that?
Because medical surgical is, well, kind of flat. It did about $11.4 billion in revenue in FY25, but growth and profits have been pretty stagnant. It doesn't fit the high-growth narrative.
So spinning it off lets the remaining McKesson focus purely on the core pharma distribution and the high-growth oncology and tech pieces.
Exactly. It streamlines the portfolio. It sharpens the focus. The message to Wall Street is pretty clear. Value our core stability, sure. But look at these growth engines, oncology and RxTS, and value them separately and value them much higher.
Okay, let's zoom in on that main growth engine then. Pillar 1, oncology and multi-specialty. This seems to be where they're placing their biggest bets for the future.
It really is. And the anchor asset here is something called the U.S. Oncology Network. This is a really significant, quite unique asset.
What is it exactly? It's not just delivering cancer drugs, right?
No, it's far beyond that. It's essentially a comprehensive practice management and technology platform. It supports around 2,600 community-based oncologists and other specialists across roughly 600 sites.
Community-based, so not necessarily in big hospitals.
Right. Primarily independent, community practices. The network provides them with everything from electronic health records, scheduling tools, clinical trial support, data analytics, even help negotiating contracts with insurance payers.
Wow. So it lets doctors focus on treating patients while McKesson handles the business and tech side.
That's the idea. It allows these community practices to gain the efficiency and scale benefits you'd normally only find in a huge hospital system while maintaining their independence.
But wait a minute. You're saying McKesson is involved in practice management, negotiating with payers. That sounds like they're moving way beyond just logistics. That's like vertical integration into actually providing care services almost.
It absolutely is aggressive vertical integration. They're moving much further down the value chain, closer to the patient and the actual delivery of care.
Is there evidence they're doubling down on this?
Oh, yes. The source materials point to recent acquisitions where they took controlling stakes in major physician groups. Florida Cancer Specialists was one. Prism Vision was another. That's clear proof of this push. They're integrating forward.
Why? What's the goal?
The goal is pretty simple. Capture more of the profit margin generated in specialty care, particularly oncology. Cancer care is consistently one of the fastest growing, highest cost, and frankly, most profitable areas in all of healthcare. McKesson wants a bigger piece of that pie.
Okay, if they're betting the company's future valuation on this oncology segment, the growth targets they've set must be pretty ambitious.
They are definitely ambitious. Management put out a crucial long-term target for this specific segment, 13% to 16% adjusted operating profit growth annually.
13 to 16% growth for that segment alone.
Yes. Now compare that to the target for the stable core North American pharmaceutical segment that's targeted in the 5% to 8% range.
So more than double the growth rate expected from the core business.
At the high end, yes.
Yeah.
That 13% to 15% figure for oncology and multi-specialty, that's the number everyone is watching. It's arguably the single most important KPI for judging the success of this entire strategic pivot.
But isn't hitting, say, 16% growth consistently incredibly hard for a business segment that's already substantial within a company McKesson's size? What happens if they only hit like 11%?
That is concisely the internal execution risk. And it's why, management compensation is reportedly tied very closely to hitting these specific segment targets.
Skin in the game.
Definitely. If they deliver that 13–16% growth consistently, the market will likely reward the entire company with a higher valuation multiple if they deliver, say, 10%, which is still pretty good growth in absolute terms.
But it's a miss versus the target.
Exactly. The market might see that as the pivot stalling and that premium valuation they currently enjoy. It could shrink back towards historical levels pretty quickly. So the pressure to execute is immense.
But the opportunity must be huge, too.
It is. Specialty oncology, especially in the community setting, is still quite fragmented. Many practices lack the capital or scale for the latest technology, or to negotiate effectively with payers. McKesson sees a massive opportunity to consolidate and optimize that space.
Okay, now let's look at Pillar 2, Prescription Technology Solutions, RxTS. This sounds like the software and data part of the strategy.
That's a good way to think about it. RxTS is focused on using technology to grease the wheels, basically, to smooth out the friction in getting complex, expensive specialty medications to patients.
Friction like what? Insurance hurdles? Cost?
All of the above. RxTS connects the key players, the biopharma companies making the drugs, the pharmacies dispensing them, and the patients who need them. They use sophisticated software platforms for things like managing prior authorizations from insurers.
Which can be a nightmare.
Absolutely. And administering copay assistance programs to make drugs more affordable, monitoring patient adherence to make sure they're taking the medication correctly.
These sound like valuable services.
Extremely valuable and generally higher margin than pure distribution because they're not just moving boxes, they're solving problems that ensure these expensive, complex drugs actually get used effectively. That's critical for the drug manufacturers.
And there was a statistic in the source material that really jumped out at me here, showing the impact beyond just McKesson's bottom line.
Ah, you mean the savings?
Yeah, it said that in the past year, this RxTS platform helped patients save over $10 billion on their medications, mostly brand name and specialty drugs.
That's right, $10 billion. And maybe even more telling.
What's that?
It also helped prevent an estimated 12 million prescriptions from being abandoned at the pharmacy counter.
12 million scripts that people might have just walked away from because of cost or hassle.
Exactly. Due to high cost or complicated insurance issues, that statistic really shows how deeply RxTS is integrated into the patient journey. They're not just processing a transaction. They're actually enabling access to care.
Which, as you said, makes them pretty indispensable to the pharma companies trying to sell those drugs, too.
Definitely. It's a key value proposition for biopharma.
Okay, and RxTS also has its own ambitious growth target, right? Just a bit below oncology.
Yes. RxTS is targeting 10% to 13% adjusted operating profit growth long term.
10 to 13%.
So you put it together. McKesson now has these two distinct high-margin growth engines. Oncology aiming for 13–16% and RxTS aiming for 10–13% that are meant to drive the company's future valuation higher.
Well, the massive core distribution business just keeps churning out the stable cash flow needed to fund it all.
That's the plan. Stability funding growth.
Now, we should also acknowledge McKesson isn't exactly swimming upstream here. There are some powerful external forces, some big tailwinds helping this pivot along, aren't there?
Oh, absolutely. They're definitely riding some major industry waves. First and foremost is just the explosion in specialty pharmaceuticals and biologics.
The really complex, often injectable, expensive drugs.
Exactly. Things for cancer, autoimmune diseases, rare conditions. These now account for more than half of all drug spending in the U.S.
More than half. Wow.
Yeah. And these drugs are complex. They often require special handling, cold storage, intense tracking, patient support services.
All things that create higher margin service opportunities for a distributor like McKesson that has the capabilities.
Precisely. It plays right into their strategy of moving beyond basic logistics.
Okay, what's the other big tailwind? It's one everyone's been talking about lately.
GLP-1s. The new generation of diabetes and weight loss drugs. Ozempic, Wegovy, Mounjaro, Zepbound.
The demand for those is just off the charts.
It's providing a massive sustained revenue tailwind for the entire distribution sector. The growth has been so explosive that GLP-1s are estimated to account for something like a quarter of all the recent revenue growth across the big three distributors.
A quarter of their growth from just that one class of drugs.
That's the estimate. And handling that sheer volume requires immense logistical capacity, huge inventory investment. It actually reinforces the dominance of the big three. Only they have the scale to manage that kind of demand reliably.
Okay, so this whole strategic pivot, moving into oncology and tech, it's only really possible because that core business is such a reliable financial engine, right? Let's dig into the financials a bit. The bedrock seems to be that cash flow.
Absolutely. It is a remarkably consistent cash flow machine. You mentioned the $5.2 billion in free cash flow for fiscal 2025. And the key point is, this isn't like cyclical cash flow that disappears in a downturn.
No, it's tied to their role as essential infrastructure. People need medicines regardless of the economy.
Exactly.
Yeah.
It's predictable, recurring cash flow. And importantly, generating that cash is highly efficient
How so?
because the core distribution business is not very capital expenditure hungry. It doesn't require massive ongoing investments year after year once the network is built.
Okay.
Looking at fiscal 2025 numbers, their capital expenditures was only about 14% of their cash flow from operations. 14%.
That seems really low for a company this size.
It's an extremely low reinvestment rate compared to, say, a manufacturer or a tech company building data centers.
Mhm.
What this low capex means is that the vast majority of that substantial cash they generate from operations. It truly is free cash flow.
Cash that's available to do other things with.
Right, ready to be deployed. Either into acquisitions to fuel those growth segments, like buying more oncology clinics, or return directly to shareholders.
Okay, cash flow machine, low capex. Got it. Now, we absolutely have to talk about the weird thing on their balance sheet.
Ah, yes. The elephant in the room.
When you are a listener, look at McKesson's basic accounting numbers, you're going to see something that looks really alarming for almost any other company. Negative shareholders' equity. Since fiscal 2022.
Mm-hmm.
For most businesses, negative equity is a huge red flag. It usually means insolvency, right? Liabilities exceeding assets, bankruptcy looming.
It usually does signal deep financial distress.
Yep.
But for McKesson, this is a critical point we need to unpack carefully. It's completely counterintuitive for a company that's clearly healthy, profitable, and generating billions in cash.
So the negative equity is not a sign they're about to go broke.
No, absolutely not. It's not about operational failure or having too much debt. It's a direct accounting consequence of two very specific major actions they took in recent years. It's an accounting artifact, not an economic reality of insolvency.
Okay, let's break those down. What was the first big action?
The first was a massive one-time event. Back in fiscal 2021, they took an $8.1 billion pre-tax charge against their earnings.
$8 billion for what?
That was to establish the financial reserve needed for their part of the huge nationwide opioid settlement.
Ah, the opioid crisis litigation payout.
Exactly.
Right.
Now, put $8.1 billion in context for McKesson's historical financials. That single charge, hitting their books all at once for accounting purposes, was so immense. It basically wiped out years and years of accumulated retained earnings on their balance sheet.
So it dramatically reduced the equity part of the accounting equation.
Profoundly. Just mathematically, it drove the book value down significantly. That was factor number one.
Okay, what's the second factor driving equity negative? You said it relates to their capital strategy.
Precisely. The second factor is their ongoing, very aggressive share repurchase program, buybacks.
How do buybacks make equity negative?
Well, think about the accounting. When a company buys back its own stock, the number of shares outstanding goes down, which is good for earnings per share. But the cash used to buy those shares, it gets recorded as a reduction from shareholders' equity on the balance sheet.
Yeah.
It's treated like a distribution of capital back to owners.
Okay.
So McKesson has been buying back billions of dollars worth of stock year after year. That sustained heavy use of cash for buybacks, combined with that huge one-time opioid charge, the total outflow eventually exceeded the accumulated earnings on the books.
Pushing the book value of equity below zero.
Exactly. It's the combination of those two things. Huge one-time charge plus massive ongoing buybacks.
Okay, so if the book value is negative due to these accounting reasons, what does this actually mean for someone trying to value McKesson? It seems like the standard valuation metrics would be useless.
They are worse than useless, honestly. They're actively misleading. Metrics like return on equity, ROE, you can't calculate it meaningfully if equity is negative. Price to book, PB ratio, also meaningless or distorted.
So you just have to ignore those entirely.
You absolutely have to look past them. They're distorted by accounting noise that doesn't reflect the underlying economic health or cash generation of the business.
So what should investors focus on instead? What metrics give a true picture?
You need to focus on metrics that measure tangible returns and operational efficiency, independent of the book value accounting. The most important one is probably return on invested capital, ROIC.
Return on invested capital. And McKesson's is.
The calculations we saw put McKesson's ROIC at a very strong 60.5%. 0.5%.
60% ROIC. Now explain why that's so significant, especially for a company people think of as low margin.
Okay, ROIC measures how effectively a company uses the actual capital it has deployed in its business. Things like its distribution centers, its inventory, minus its operating liabilities like accounts payable to generate profits.
Okay.
McKesson, as we discussed, is fundamentally a capital-light business for its scale. They don't need massive factories like a manufacturer. They manage their working capital incredibly efficiently. So that 60.5% ROIC shows phenomenal capital efficiency.
It proves they're getting huge returns on the actual money tied up in the operation.
Exactly. It bypasses the noise from the negative equity figure and shows the true underlying profitability and efficiency of the enterprise. It's a much better measure of performance here.
Okay, ROIC is key. What else? You mentioned cash flow earlier.
Yes, cash flow metrics are crucial. We relied heavily on free cash flow yield,
And that was around.
approximately 6.0% based on recent numbers.
And what does that 6% tell us?
It tells you how much tangible, spendable cash the company generates relative to its total stock market value. It gives you a clear picture of the real cash return the business throws off for its owners, regardless of what the accounting book value says. It's a very practical measure.
Got it. ROIC and free cash flow yield. Ignore the negative equity noise.
That's the key takeaway on the balance sheet puzzle.
And that strong, real cash flow feeds right into their capital allocation strategy, how they decide to use that cash, which seems heavily focused on returning it to shareholders.
Overwhelmingly so. Their primary tool for returning capital is definitely the share repurchase program, aggressive buybacks.
How aggressive?
Well, in fiscal 2025 alone, they bought back $3.1 billion worth of their own stock. And the board had previously authorized another $6.0 billion for buybacks starting in July 2023.
So they're spending billions buying back shares.
It's their main lever for boosting shareholder value. They are explicitly using that massive stable cash flow from the core business to reduce the number of shares outstanding.
Which automatically increases earnings per share, all else being equal.
Directly and immediately. Shrink the denominator.
They do pay a dividend too, though, right?
They do maintain a dividend, yes.
Yeah.
And they emphasize consistency there. They announced a 15% increase in July 2025 that marked the 9th year in a row they've raised the dividend.
9 years of increases. That sends a signal.
It does signal confidence and stability. However, you have to look at the payout ratio. The amount they pay in dividends is actually a very small fraction of their earnings.
How small?
The dividend payout ratio is only around 8.5% of their adjusted earnings. Really low.
Okay, so the dividend is more symbolic, maybe? A sign of health?
I think that's fair. It shows commitment. But it confirms that the main way they return capital, by far, is through the buyback program. That's where the big money goes back to shareholders.
Okay, so they're this indispensable giant, executing a big pivot, generating tons of cash. But it's not all smooth sailing, right? Even being a leader in an oligopoly doesn't mean you have no challenges. They've faced some significant headwinds, especially over the last few years.
Oh, absolutely. No business operates in a vacuum, especially one this size and this central to the healthcare system.
What's the first big structural challenge they're always fighting? You mentioned the thin margins earlier.
Right. It's that persistent underlying drag from generic drug pricing deflation. It's a constant battle.
Deflation, meaning the prices of generic drugs keep falling.
Generally, yes. Distributors like McKesson historically earn better gross margin percentages on generics compared to branded drugs. But the generic market is intensely competitive. As soon as a drug goes off patent, multiple manufacturers jump in.
It becomes a commodity, prices fall.
Exactly. It's that race to the bottom dynamic we talked about. So McKesson has to find massive operational efficiencies, cut costs relentlessly every single quarter just to tread water, just to prevent those falling generic prices from eating away at their already slim 1-2% overall operating margins.
Constant pressure just to stand still on margins.
Constant pressure. That's the nature of the beast in distribution.
Okay, what's another major headwind? You mentioned the oligopoly structure that sounds like a double-edged sword. Stability, yes, but also scrutiny.
Exactly. Regulatory scrutiny and what you might call headline risk.
Yeah.
Being one of only 3 dominant players provides stability, sure, but it also puts a giant target on your back.
A target for who?
Regulators, legislators, antitrust authorities. They become a high-profile focus.
Especially with this move into owning physician practices, that vertical integration.
That's a key area of scrutiny right now, yes. Regulators are looking very closely at the potential anti-competitive effects of distributors owning large oncology networks. Does it steer patients? Does it disadvantage independent practices? That's the kind of question being asked.
So the very strategy they're using to find higher margins invites more regulatory heat.
That's the trade-off. Moving into potentially more profitable areas brings you under a different kind of microscope. And beyond antitrust, there's always the risk of broader drug pricing legislation.
Like the Inflation Reduction Act. Or maybe future attempts to regulate PBMs, the pharmacy benefit managers.
Right. Any major legislation aimed at lowering drug costs could potentially ripple through the entire supply chain and squeeze distributor profits indirectly, even if distributors aren't the primary target. That political and regulatory uncertainty is always there.
Okay, but one massive uncertainty that hung over them for years seems to be resolved now, right? The opioid litigation.
Yes, that financial overhang, which was huge, has largely been lifted. The National Settlement Agreement provides finality.
McKesson's share was what, about $7.9 billion?
Roughly $7.9 billion, yes. And critically, it's structured to be paid out over a long period, 18 years.
So it's manageable.
The key takeaway is that the liability is now known. It's quantified, it's budgeted for, it's manageable within their cash flow. The uncertainty is gone. However,
there's always a catch.
Well, the resolution itself has ongoing costs beyond just writing the checks. This settlement mandates significant, lasting, and quite costly operational changes.
Like what?
Enhanced compliance systems. They've had to invest heavily in sophisticated technology to monitor orders for controlled substances much more rigorously, looking for suspicious patterns. And that's not a temporary fix. Those compliance burdens are now a permanent cost of doing business.
Okay, so opioid liability quantified, but compliance costs are ongoing. What about operational headwinds? The supply chain itself has been chaotic lately.
Hugely chaotic. First, there was the post-COVID normalization, which sounds good, but for distributors, it meant losing the very high margin revenue they were getting from distributing COVID vaccines and tests. That was a temporary profit bump that went away.
Okay, loss of that high margin business. What else?
A much bigger, more persistent operational challenge has been the crisis of widespread drug shortages.
We hear about those all the time. Shortages of basic antibiotics, chemo drugs.
Exactly. It reached a record high in the U.S. in early 2024. Something like 323 different drugs were in active shortage. Often older, basic, low-cost generic drugs.
How does that impact McKesson? Does it actually cost them money?
Oh, absolutely. It hits those thin margins hard. When a standard drug isn't available, McKesson's sourcing teams have to scramble. They spend countless hours searching for alternative suppliers, sometimes paying higher prices for the alternative, managing complex logistics to get it where it's needed.
It just makes their job way harder and more expensive.
Exponentially increases sourcing complexity and cost. It puts tremendous pressure on the efficiency of the whole system, which, as we keep saying, is the only way they really make money in distribution.
So they're dealing with generic price pressure, regulatory scrutiny, ongoing compliance costs, drug shortage complexity, and presumably wage inflation and labor shortages like everyone else.
Yes. Add those macroeconomic pressures into the mix, too. Finding and keeping warehouse workers, drivers, skilled technicians isn't easy or cheap.
So facing all that, how do they protect that fragile 1% margin? What's the internal response?
The only real answer is technology and automation. Relentless investment there.
Robots in the warehouses, AI for forecasting.
All of the above. McKesson is deploying robotics for picking and packing, highly automated sorting systems, AI for demand forecasting, and inventory management. These aren't just nice-to-haves, they're strategic necessities now.
Why? Just to cut costs.
It's twofold. Yes, automation helps offset rising labor costs and mitigate shortages, but it also increases accuracy and speed, which is critical for meeting customer expectations and maintaining that 99% accuracy rate. In this business, operational excellence driven by technology isn't just a goal, it's absolutely essential for survival.
All right, let's try to pull this all together. We've looked at the business, the strategy, the cash flow, the risks. How is the market actually viewing McKesson right now? Now that this strategic pivot is clearly underway and some of the big risks, like opioids, are more defined.
Well, looking at the valuation metrics, the market seems pretty optimistic, maybe even enthusiastic.
How can you tell?
If you look at McKesson's trailing 12-month price-to-earnings ratio, its PE ratio, it's sitting around 27.8x right now.
Okay, 27.8. Is that high or low? How does it compare?
It's definitely on the high side, both historically for McKesson and compared to its peers and the broader sector. If you compare it to, say, Cardinal Health, its direct competitor, Cardinal's PE is around 23.1x, and the average PE for the broader U.S. healthcare industry is about 21.5x.
So McKesson's trading at a noticeable premium to its closest competitor and the healthcare sector overall.
A significant premium, yes. And maybe more importantly, it's a premium to McKesson's own recent history. Its average PE over the last 3 years was closer to 22x.
So that jump from around 22x to almost 28x, that premium is basically the market saying, we believe in the pivot.
I think that's exactly what it signifies. Investors are already giving McKesson credit for this strategic shift. They seem to be pricing in the expected higher growth trajectory from those oncology and RxTS segments.
They're valuing it less like a pure utility and more like a company with real growth prospects.
It certainly looks that way. The market appears to believe management can successfully execute this transition, moving from being valued as a low multiple distributor to becoming a higher multiple specialized healthcare services company.
And that market optimism seems to line up perfectly with what management itself is saying about the future, right? They recently updated their long-term guidance.
They did. In that September 2025 announcement, alongside the restructuring news, they actually raised their long-term target for adjusted earnings per share growth.
Raised it? To what?
They bumped it up to a range of 13% to 16% compound annual growth. That was up from their previous target, which was 12% to 14%.
So they're even more confident now about delivering strong earnings growth over the long haul.
That increase signals tremendous confidence. Confidence in the durability of those tailwinds. We talked about specialty pharma, GLP-1s, and crucially, confidence in the ability of those dedicated oncology and RxTS growth segments to really drive accelerated earnings.
And those segments have their own targets that feed into that overall 13-16% EPS goal.
Exactly. Remember, oncology is targeting 13-16% operating profit growth, and RxTS is targeting 10-13%. Those are the engines expected to power that overall strong EPS performance. It provides a clear roadmap for how they plan to get there.
Okay, so the market's optimistic, management's confident, the structural risk seems low because of the oligopoly mode. So where's the risk now? If you own McKesson stock, what keeps you up at night? It seems like the risk has shifted almost entirely to execution, right?
I think that's largely true. The risks now seem much more focused on whether they can actually deliver on this ambitious plan. You can break them down into external and internal risks.
Okay, external risks first. What's the big one?
Still regulation, primarily. The main external threat remains the possibility of aggressive new government action. Specifically, you'd worry about antitrust actions really challenging their acquisitions of physician networks.
Trying to unwind that vertical integration in oncology.
Potentially. Or maybe new drug pricing legislation that finds a way to significantly squeeze profits across the entire supply chain, hitting distributors harder than expected. That's always out there.
Okay, regulatory is the big external unknown. What about internal risks? Failure to execute.
That's the critical internal risk. Simply put, what if they just don't hit the numbers? Especially for that high-value oncology segment. If they consistently fail to deliver that targeted 13-16% operating profit growth,
The whole Graith story kind of falls apart.
the narrative collapses, yes. The premium valuation would likely evaporate pretty quickly if the market loses faith in their ability to execute on the oncology strategy. That's probably risk number one.
And what about that other big move, spinning off the medical surgical business? That sounds complicated. Could they go wrong?
It definitely could. Executing a large spinoff like that is complex and fraught with potential pitfalls.
Like what?
Well, a botched execution could mean delays in completing the separation. Or maybe they fail to get the optimal tax-free structure they want. Or perhaps they end up retaining significant stranded costs, overhead expenses that were supposed to go with the spun-off business, but end up staying with McKesson, dragging down margins.
Any of those would undermine the rationale for the spin-off in the first place.
Exactly. It would mess up that purification thesis and likely cause the market to punish the stock, contracting the valuation multiple. So smooth execution of the spinoff is also critical.
But it sounds like management is pretty focused. And you mentioned their incentives seem aligned with shareholders.
They appear to be completely aligned, yes. As we discussed, management compensation is reportedly tied directly to hitting those ambitious growth targets, particularly for the key segments. That gives them strong motivation.
And the buybacks.
And crucially, that commitment to massive share reduction through buybacks. The fact that they're spending far more cash buying back stock than they issue in-stock options to insiders, that shows a clear focus on driving value for the public shareholders. They're using the cash machine to shrink the share count and boost EPS. Their interests seem very much aligned with investors. Hashtag day age outro.
Okay, so let's try to synthesize this whole picture for you, the listener. McKesson presents this fascinating duality, doesn't it?
It really does. On one hand, you have this absolutely massive, essential, but low-margin logistics utility. That's the stable core, the foundation.
The indispensable giant running the circulatory system.
Right. But then, layered on top, or maybe emerging from within, you have this increasingly nimble, high-growth provider of technology solutions and specialized oncology services.
The Ferrari engine inside the utility truck.
Exactly. It's those two things operating together.
And when you look at the financials, especially that confusing negative shareholders' equity, we have to remember what the accounting doesn't capture, right? The intangibles.
Absolutely critical. The balance sheet doesn't show the true value of their dominant market position. It doesn't quantify those incredibly high barriers to entry that protect the oligopoly.
Or the network effects.
Or the powerful network effects they're building, especially with the U.S. Oncology Network. Those are huge, unrecognized assets from a pure accounting perspective. And things like, it's not an ADR, internal dilution seems well controlled.
Yeah.
Those matter too. But the market position and barriers are paramount.
And that underlying stability they provide. It's really everything, isn't it?
It is. It fundamentally removes the risk of catastrophic failure. The chance of McKesson just disappearing, going bankrupt, given its essential role in North American healthcare, it's vanishingly small.
Too big or maybe too essential to fail.
Arguably.
Yeah.
And that rock-solid stability, that guaranteed baseline cash flow, is what gives them the freedom, the financial runway, to actually execute this ambitious pivot into higher growth, higher risk areas like oncology. They can make these big bets without facing existential pressure if something goes slightly wrong.
Which leads us to our final provocative thought for you to mull over.
Okay. The market, as we've seen, is now being asked to value McKesson differently, to put a much higher value on the future potential of these specialized service businesses, oncology, RxTS, compared to the core commodity distribution business.
Right. They want the market to see the Ferrari, not just the truck.
Exactly. So here's the question. If that core distribution business truly is almost too big to fail, protected by those near impenetrable barriers, generating guaranteed cash flow, how much of a premium should the market really place on that underlying stability itself?
You mean, does the stability deserve its own premium valuation because it enables the growth pivot?
Precisely. That stability removes the downside risk, the chance of total loss, which is rare for most companies undergoing transformation. It allows this strategic evolution to proceed with a safety net. So how much is that safety net worth while they pursue this ambitious, potentially much higher value future? It makes McKesson a really unique story. Utility stability underwriting high-growth healthcare speculation. Something to think about.